Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Jay Gragnani, Head of Research and Client Engagement with Nasdaq Dorsey Wright, to discuss the health of the market as we are in the thick of earnings season and if the old adage, sell in May and go away, will play out in 2021, and for some historical perspective. Jay, it's great to see you as always. Welcome back to Trade Talks.
Jill, great to be here.
All right, let's start with a checkup on the S&P 500 as we are really in the thick of earnings.
You're right. I mean, this week, especially a lot of earnings coming out, a lot of big earnings coming out with large tech announcing a lot of earnings. And when we take a step back for a second, it's very easy to get wrapped up in the earnings news and announcements right around the earnings. But it's very, very important too right now, especially to take a step back and look at the market. And when we take a step back and we look at the market, and whether you're talking about a specific index like the S&P 500 or the Nasdaq 100, or even the Russell 2000, for instance, in the small cap capacity, we continue to see a generally positive picture across the market. Specifically as it relates to the S&P 500, the overall trend is positive. And in the month of April, we've seen, after a bit of consolidation in March, we've seen the S&P move ahead by leaps and bounds right now. And specifically as it relates to the point and figure chart of the S&P 500, we've seen a very interesting pattern develop on that chart. It's a pattern that we would refer to as a bullish triangle breakout. Without getting too technical, that is one of the bullish chart patterns that we follow, suggestive that after a near-term period of consolidation on the chart, we saw a breakout to the upside, which is a suggestive sign that demand is continuing to be in control of this market today. So that in and of itself is a positive sign. But I think it's also important too to look at, the participation and the breadth that we're seeing within the market. And what I mean by that is, are just a few stocks carrying the market, or is the market really participating in a broad way? And there's a couple of ways that we can measure that. One of those is just looking at the percent of stocks in the S&P 500 that are trading in positive trends today. So if we took all 500 stocks and say which percentage of those are trading within an overall positive trend, that number today is 92%. And that is historically a very high number, but is also historically a very, very positive sign. Anytime you see a reading north of 50% for that indicator that we follow, in other words, if at least the majority of stocks are in positive trends, that historically has been a very bullish, a very positive sign for the market. Where we begin to get concerned is if that number falls below 50%. But again, the fact that we're up at 92% would continue to be a positive sign for the market. So long story short, all that being said, Jill, as we're in the thick of earnings season, we continue to see generally positive outlook for the equity markets.
And if we drill down further and take a look at the asset classes, what are the rankings showing?
Yeah, so right now, and has been the case for going on almost a year now, back in August of last year, U.S. equities continues to be our top ranked asset class from a relative strength perspective, followed by international equities and commodities. And so those three asset classes are up in the top of Dolly as the strongest areas of the market. The more risk investors are certainly continuing to accept and wanting to accept more risk within their portfolios, which is evident by those three asset classes being up at the top. On the other end of that spectrum, when we look at the bottom of the rankings, we see our more defensive areas like fixed income, like cash and currencies as well down there towards the bottom. But it's very much equity dominant. And again, when we say U.S. equities, it's not just a few areas. Just this year alone, when you look at the macro sectors, we have seen 8 out of the 11 macro sectors put together double-digit returns thus far through the year, through almost the end of April, through late April. And again, that is just suggestive that this rally that we're seeing in the market is very much broad-based in nature, while energy and financials are leading from a sector perspective, up each individually 20% when you look at just the sector spider ETFs as representative proxies. Energy financials right there at the top. But again, 8 out of 11 are up double digits this year. Really, those areas that have lagged the market has been, narrowly concentrated in some more interest rate sensitive sectors, more defensive sectors, namely staples as well as utilities.
And Jay, to wrap up here with April wrapping up, we are ending the seasonally strong 6-month period in the market and approaching the sell in May and go away time period. What are the implications of that? Give us some historical perspective.
Yeah, it's, when that May 1st rolls around, that is just one of those time periods in the market that harkens that sell in May and go away period. And there's a reason that adage became popular within the markets is because if you look over a long period of time, and by long period of time, I mean going all the way back to like the 1950s, long periods of time, a bulk of the return in the market has been seen during the seasonally strong period that's getting ready to conclude. And so that period historically starts at the end of October and goes through the end of April. That's the seasonally strong 6-month period in the market. As we move into May 1st, that is what is historically referred to as the seasonally weak period in the market, and that's where the sell in May and go away adage comes from. If you look at numbers here more recently, I mean, the past 5 seasonally weak periods, so to speak, so the last 5 periods that we've seen in the market, they've all produced positive returns for the market. And really, if you go back over the past 11 years, you've seen basically 8 out of the past 11 have been positive. So while there's some certainly historical bias to that long term, that adage is not something that's going to necessarily drive decisions and drive us to necessarily say it is time to sell and go away, especially when we continue to see indicators like we mentioned earlier, U.S. equities being the strongest asset class, with a lot of broad participation continues to suggest a generally healthy equity market, even as we move into the May period in 2021.
All right, Jay, appreciate the insight. As always, we'll have to take a check back with you with our monthly hit at the end of May to see exactly how this plays out. Great to have you with us as always on Trade Talks. Thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.